Hello students, hope you are doing well. Today in this video we are going to discuss the activity ratio and the profitability ratio. In this video we are going to discuss their formula, and after seeing this video you are able to solve the numericals. This is the last video of accounting ratio, and it is really helpful for you for making the notes of the ratios which are based on some components of P&L. So let's start. Activity ratio. Activity ratio is that ratio which is basically formed for the testing the efficiency and rapidity of the resources of the company, like inventories, fixed assets, working capital, trade receivable, and etc. These ratios are generally calculated on the basis of revenue from operation, or you are familiar with this name, that is cost of revenue from operation. Some important activity ratio are discussed here. First is inventory turnover ratio. This ratio indicates the relationship between cost of revenue from operation, that is cost of goods sold, during the year and the average inventory kept during the year. Okay, so what is the formula of this? Cost of goods sold upon average stock. Okay, or we can say that cost of revenue from operation upon average stock. So what components are included in cost of revenue from operation? First is cost of material consumed. Second is purchase in stock and trade, change in inventory of stock and trade, work in progress, and direct expenses which are involved in the production of goods, that is wages, carriage, freight, power and fuel, etc. Okay, so these are the components which are included in cost of revenue. Here another formula is opening stock of inventory plus purchase plus direct expenses less closing stock, as you prepare in class 11th. Okay, and also you can use this formula, that is revenue from operation, that is net sales less gross profit. Okay, now how you calculate average stock? Average stock is equal to opening stock plus closing stock divided by 2 as you calculate the mean. So this is the formula of activity ratio. Activity ratio is basically that ratio whether the inventory has been efficient use or not is shown. It shows the speed which the inventory is rotate into the revenue from operation to revenue from operation during the year, and the higher the ratio is the better. So if the inventory turnover ratio is higher, it is better. A lower inventory turnover ratio indicates the inventory does not sell quickly and remains lying in the go down for the quite long time, which is not good for organization. So if inventory turnover ratio is higher, it is good. If inventory turnover ratio is lower, it is bad. Remember this, and it is helpful in further questions for commenting about the position of the company, whether it is good or bad. Sometimes in question they ask you about the comment or suggest about the company's position. Okay? Now, debtors turnover ratio or trade receivable turnover ratio. In this ratio, we indicate the relationship between credit revenue from operation and average trade receivable during the year. Okay? So, the formula is net credit sales upon average trade receivable. Debtors turnover ratio is also calculated on the base of the formula, that is net credit revenue from operation upon debtors plus bill receivable. How you calculate trade receivable? Trade receivable is calculated debtors plus bill receivable. Average trade receivable is divided by 2. Now, net credit sales is calculated by net sales less cash sales. As from the net sales you less the cash sale, the remaining is, but obvious, it is a credit sales. Whether the net sales is gross sales plus, minus sales return. Okay? And in this question, the provision for doubtful debts are never deducted from debtors. This ratio indicates the speed with which the amount is calculated from trade receivable. The higher ratio, the better it is, since it indicates the amount from trade receivable is being collected more quickly. Okay? The more quickly the trade receivable is paid, the less the risk from bad debt. And so, the lower the expenses of collection and increase in liquidity of the firm. Right? Now, creditors turnover ratio. It is also called payable turnover ratio. This ratio is calculated for knowing the creditor's position in an organization, whether the position of the organization is good or it is better, they are paying their credit on time or not. Okay? So, trade payable turnover ratio is that ratio which indicates the relationship between credit purchase and average trade payables during the year. The trade payable turnover ratio is equals to net credit purchase upon average trade payables. This ratio comes in number of times, as you know, and this ratio indicates the speed with which the amount is being paid to trade payables. The higher the ratio, the better it is. So, the trade payables is equal to trade creditors plus bills payable, and average is calculated by dividing by 2. Net credit purchase is calculated that gross purchase less purchase return, and cash purchase is also deducted. The provision for discount on creditor is ignored and it is not used in the calculation. If the credit purchase is not given, the total purchase is taken, and if the opening payables are not given, the closing payable is treated as an opening payable. Here one more formula is written, that is average payment period. Sometimes you are asked to calculate average payment period. So it is calculated based on 365 days or the 12 months. You have to identify in the question whether they are given the question in days or in the months. Okay? Or you can calculate on whether you are like to calculate on months or the days. The trade payables turnover ratio could be converted into the average payment period, which indicate the period which is normally taken by the firm to make the payments. and it is calculated as 365 days or 12 months divided by creditors or trade payable turnover ratio. Okay, so it is quite easy to calculate. The last activity ratio is working capital turnover ratio. As in first ratio, that is liquidity ratio, you are able to calculate the working capital. Now the working capital turnover ratio is just based on this, like it is based on net working capital and from the revenue from operation. The ratio is of particular importance in the non-manufacturing concern where the current asset play a major role in generating the revenue from operation. So it is calculated as net sales or revenue from operation, whatever it is given in the question, divided by net working capital. Okay, so it is quite easy. And how you can calculate is working capital is equal to current asset less current liability. Net sales or revenue from operation divided by net working capital, the answer will become in number of time. If the sales is not given, it is calculated on cost of goods sold upon net working capital. Okay, so these are the ratios which are very important you have to calculate in this activity ratio. Now what is the profitability ratio? The profitability ratio knows the profit of the company, whether it is earning profit or not. The main objective of this ratio is knowing the concern is earning profit. The business must be able to earn adequate profits in relation to the capital invested in it. The efficiency and the success of the business can be measured with the help of profitability ratio. The profitability ratio can be divided into two, that is general profitability ratio and overall profitability ratio. So general profitability ratio include gross profit ratio and operating ratio, operating profit ratio, net profit ratio. And overall profitability ratio you have to study in this book is only one ratio, that is return on investment. Okay, so now we discuss the profitability ratio. So first is gross profit ratio. Gross profit ratio establishes the relationship between gross profit and revenue from operation. Okay, that is called net sales. The ratio is computed and present in percentage, and formula is gross profit ratio, that is gross profit upon net sales, net revenue from operation into 100, because it is calculated in the form of percentage. Now how you calculate net sales? That is cash sales plus credit sales minus sales return. If there is net revenue from operation, you can calculate it from this formula, that is cash revenue from operation plus credit revenue from operation less revenue from operation return. Okay, how you calculate gross profit? Remember that in class 11th, sales minus cost of goods sold. Gross profit is equal to revenue from operation less cost of revenue from operation, that is cost of goods sold. The cost of goods sold or the cost of revenue from operation is calculated from opening stock plus purchase plus direct expenses less closing stock. Okay, the cost of revenue from operation or cost of sales is calculated on these formulas. The cost of material consumed plus purchase of stock in trade plus change in inventories of finished goods and work in progress plus direct expenses. And the second is net revenue from operation, that is sales less gross profit. So These are formulas, alternative formula, which are used in calculation of gross profit ratio. Now, operating ratio. The operating ratio is that ratio which are measured the proportion of an enterprise cost of revenue from operation and operating expenses in comparison to revenue from operation. So, operating ratio is operating cost upon net sales into 100. Okay, so it is also calculated in the number of percentage, and you can also use this formula, that is operating ratio is equal to cost of revenue from operation plus operating expenses divided by net sales or revenue from operation into 100. How you can calculate cost of revenue from operation? Sales minus gross profit, or the cost of revenue from operation is equals to opening stock plus purchase plus direct expenses less closing stock. The cost of material consumed plus purchase of stock in trade plus change in inventories of finished goods plus work in progress and stock in trade plus direct expenses. The operating expenses is calculated, which is based on employees' benefit expenses, depreciation and other expenses. Okay, so it is quite good and very easy, and operating expenses sometimes include the discount, the bad debts, selling distribution expenses, interest on short-term loans. Okay, if there is trading company, then trading commission receive and cash discount receive is also included. Okay, the spare parts and the loose tools are excluded from the inventory. Okay, so what is the significance of this ratio? The operating ratio is measurement of the efficiency and profitability of the business enterprise, and the ratio indicates the extent of the revenue from operating activities and knowing the absorption of the cost in the revenue from operation, right? Now, operating profit. Operating profit ratio is calculated in this formula, which is very important to distinguish between operating ratio and operating profit ratio. You keep on check whether in question what formula is asking, what ratio is asking. This ratio shows the relationship between operating profit and net revenue from operation. So it is calculated on operating ratio or operating profit upon net revenue from operation. You can write here, that is operating profit, right? Operating profit. Okay, so operating profit is calculated net revenue from operation less operating cost, or net sales less cost of goods sold plus operating expenses, or gross profit less operating expenses plus other operating incomes. Operating profit ratio is equal to net profit before tax, that is EBIT, plus non-operating expenses or losses less operating incomes divided by revenue from operation, that is sales. The operating profit is arrived by the deducting all the operating expenses from gross profit, such as employee benefit expenses, depreciation, office and administration expenses, selling and distribution expenses, discounts, bad debts, interest, etc. It is important to note that if the net profit is given in the quotient, operating profit may be calculated as by the formula, that is operating profit is equal to net profit before tax plus operating expenses and losses less operating incomes. Okay. Now, net profit ratio. As you know, you have calculated net profit before, and it is quite important to know whether the company is earning good net profit or not. So the net profit ratio is that ratio which establishes the relationship between the profit and net revenue from operation. So the formula of this is quite easy, that is net profit upon net sales या revenue from operation into 100. Net profit is equal to revenue from operation, that is sales, less cost of revenue from operations plus operating expenses plus non-operating incomes less non-operating expenses or losses. So net profit is equal to gross profit plus other income less indirect expenses as you calculated in 11th class. So net profit ratio is equal to net profit after tax divided by net sales, that is revenue from operation, into 100. Okay. Now, the return on investment, it is the last formula of this, and this chapter ends here. That is return on investment, as you studied in business studies also, that the ratio reflects the overall profitability of the business is called return on investment. It is calculated by comparing the profit earned and the capital employed to earn it. The ratio is usually percentage and also known as rate of return or return on capital employed. All the ratios are based on this ratio. This is very important. The term of investment here refers to the long-term funds in the enterprise, as earlier long-term funds are also known as capital employed, which means the total shareholders funds in long-term loans. Okay. So the ratio is calculated, return on investment is equal to net profit before interest and tax, that is EBIT, into 100 or divided by capital employed, then into 100. Okay. So capital employed is equal to shareholders funds and long-term debts. The capital employed by the assets are non-current assets plus non-current investment plus long-term loans and advances. Okay. So there are some alternative formulas are also given and you can use them. Working capital, as you know how to calculate working capital, current assets less current liability are used here. Okay. So first of all you have to calculate capital employed, that is non-current asset plus working capital. Non-current asset is equal to tangible asset plus intangible assets plus non-current investment plus long-term loans and advances. So this formula is not only based on the P&L but also based on the balance sheet. If you have clear view of both of the formats of the statements, that is balance sheet and P&L, you are able to calculate the ratios. The significance of this ratio is the overall business enterprise, the ratio is a barometer of the overall performance of the enterprise, and it measures the efficiency of the capital employed in the business which is used in the business, and in other words we can say that it measures the earning power of the net assets of the business. Even the performance of two dissimilar firms may be compared with this ratio. So this ratio is very, very important, and most of the time this ratio is asked in a question to be calculated. Okay. So here your chapter ends here. You have to remember all the formula, and the easy way to remember these formula, solve the questions. More question you solve, it will be able to use and remember by yourself. Okay. So here the video ends and the chapter also, and the question should be solved by all the students, and this formula will be helpful for calculating all the ratios. And here I end the chapter. Thank you.